So, good afternoon, good day, good morning, whatever time of day it is, wherever you are as you are watching this. Welcome to the next video in the series called Our Affordable Housing Tour. We've been focused on working towards trying to clear up a lot of misinformation as relates to housing affordability and also affordable housing programs, because there's a tremendous amount of misinformation that exists around this topic, because housing costs have gotten to a place where they are less affordable for many. For that reason, there is a lot of grief, a lot of grumbling, and with grief and grumbling becomes comments that become fact, where there may be other realities, and we want to focus on those other realities, which is first and foremost is that housing affordability can still be achieved. People can still qualify to buy houses. They may not be able to buy where they want to buy, but that's always been the case. But the next thing and the next part of that goes to the fact there are programs and opportunities exist that may or may not be known to everyone. And because of that, there's many people that are unaware that there's an opportunity for them, because if it's not commonplace, common information, if you will, then at that point in time, people sometimes miss it. And programs related to affordable housing are meant to serve a particular segment of the population. Many people that don't qualify, aren't concerned with it, don't worry about it, don't talk about it because they don't fit. However, there are other people that do fit. And these series of videos are designed to help those people that may qualify have the information at their fingertips, in theory, so that they can delve deeper into their opportunities. So my name is Corwin J. Millett. I'm the broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina, co-owner of Exit Realty New Horizons in Columbia, South Carolina, radio host, and a number of other things that for today isn't necessarily as relevant. But I wanted to give that insight because I am a 22-year veteran in the real estate industry. And let me phrase that, veteran. I've been at it for a while. So I've been doing this for 22 years. I've been in affordable housing for 20 or over 20 years, helping people achieve home ownership, leveraging down payment assistance and other government and local government and nonprofit partner programs in order for them to be able to qualify. Today, we're going to talk about income. We're going to talk about credit. We're going to talk about debt. We're going to talk about strategy. And also, we're going to leverage up and tee us up for the next steps. There is another video in this series that will be after this. So please make sure, not only if you're just catching this, that you go back and get the information or request the access to videos prior, but that you also make sure that you come back and tune in for the next video in the series, where we'll kind of be working to kind of get us close to or otherwise wrapped up on our explanations. So we'll go ahead and get started. And we'll start with a mindset component. It's one of the things that I always work to do. I work to talk about what people think becomes their reality. So what people do becomes their existence. So we want to be very clear, very honest. Most people don't take the action that they could, sometimes because they don't know what to do, right? So we're going to work to hopefully change some of that in this session today. But most people believe they don't qualify for affordable housing. That's why they don't try to. That's why they don't explore the option. Don't think they qualify for down payment assistance. So that's why they don't try. Reality is very simple. And that reality is that the real barrier here isn't necessarily that they don't have the ability to qualify. It's just they don't know where to start, and they're not being connected to people who actually know where opportunities exist and how to help navigate that landscape. So there are countless buyers out here, just like some of you who are watching this, who qualify, for affordable housing programs. But because they think that they don't have perfect finances or, perfect credit or a lot of income, they never ever engage, they never ever talk with anyone, come up with a plan or a strategy, and they never ever take the first step. So the real goal here is not to be perfect, all right? The reality, again, and you'll hear me talk about the reality, because the reality is what a truth is, or the truth is, which is not everyone has perfect credit. There's things that happen, whether you miss a payment, altogether, you're late on a payment, maybe you didn't open the right type of credit account, whatever that may be, whatever that may look like. There's no such thing as just the perfect file. A great file, yes, but perfect, no. Your goal is to get to where you qualify. So a lot of buyers put off homeownership, waiting or thinking they need to wait until they have perfect credit. Truth is, lenders qualify people with less than stellar credit all the time. And there are assistance programs, as we will continue to talk about, that necessarily don't look at credit altogether. And some that do, they're not looking for perfect credit either. They're just looking for someone, or they're designed for people who are eligible, who meet whatever guidelines that are established for that particular program. So understanding what that means is your first step towards home ownership. So we want to encourage you to stop waiting, because perfection is the enemy of progress. People who do great things don't do great things because they did it perfectly. They did it because they were persistent and didn't stop. So understand that qualification, you qualifying for a home, is possible right now. Number two, start moving. Make intentional steps towards creating the momentum that you need in order for you to get to your goal. And last but not least, make sure that you get yourself in order, that you get yourself aligned, to get your finances or whatever else in alignment with the program that you may be after, or otherwise understand what your finances are so that you can get guidance on what you are in alignment with. That's where your real strategy is. So let's talk briefly about what qualifying really means. So qualifying for affordable housing assistance isn't about necessarily impressing someone. Social media has told us and tells us that it's the highlight reel. So oftentimes, we really kind of put that information out there to highlight, if you will, what we've done and what we're doing. But it's not about impressing someone. It's about just having your business in order. It's about having yourself in alignment. So your financial profile needs to line up with program requirements if you're going to be eligible, right? That's very direct. So number one is your income. You need consistent, verifiable income. Meaning, if you work part time, part of the time, meaning you got a part time job now, you'd work for 2-3 months, you don't work for another 6 months or a year, then you work another part time job for 2-3 months. And so that's not consistent income. If you work, and we'll use this term, under the table, meaning that you're not paid wages, you don't have a W 2 or other documentable sources of income, then that's going to be a problem as well. Programs typically require consistent and verifiable income. All right. So please make sure that you are able to provide that, or work on getting in alignment so that you can in the future. The next thing is credit. Your credit score and your credit history are a blaring flag to lenders. Okay. Now, I want to be fair and I want to be concise, but also repetitive here to say that perfect credit isn't necessary. Okay. Your income is your ability to repay. Your credit signals your willingness to repay. Those two things go hand in hand. So if you make good income, but you have poor credit, that tells a lender, hey, you know what? They make enough money to be able to pay us, but they don't look like they want to pay us. Vice versa, if you have great credit, there's a willingness, but the ability may not be there. So we want to make sure those two things are, in theory, aligned. The next thing is your debt, your monthly revolving debt. Oftentimes, people will throw around, make mention of debt to income ratios. These are your monthly obligations, your minimum payment on credit cards, on your required payment on loans, those things that show up on your credit report, not your monthly obligations, such as, and if you're renting, rent doesn't show up on your credit. Your grocery bill, your light bill, water bill, if you have that, cable, internet, those things don't show up on your credit profile unless there is an outstanding balance that has a judgment, that judgment may show on your credit. But your monthly obligations, and there is a calculation that goes into this, and it's called a debt to income ratio. So if you make $5,000 a month in gross monthly income, but you have a uh, you know $1,000 a month that goes out in revolving payments, car payment, credit cards, loan payments, or what have you, then before you even insert a housing payment into that amount, you already have a 20% debt ratio. Then once you fit a housing payment in there, then that tells you what you can go to as far as a max housing payment. And there's a lot more to that, so we won't go too far into that explanation. But I want you to understand that at a very high level, your income, your credit, and your revolving monthly debt are three of the most important things that get you to qualification. The next thing is structure. So structure, the right loan program matched with the right down payment assistance program or otherwise, putting these things together allow you to get to a specific scenario that may allow you to get into home ownership. So this is where strategy really comes in. How do you structure a deal? How is a deal structured? And this is for your quarterback, your real estate agent, your realtor. Obviously, I hope you're using an actual realtor, but your realtor and and lending partner are the people who really work to pull this stuff together. So, as a quick recap, the three areas that matter most out of this again are your income, how much you earn, and that you consistently earn it, your credit, which is your payment history, the score, and where you're going financially, what that looks like on paper. And then last but not least is your debt, your monthly obligations. No matter what type of program you may qualify for, these three things are like the big hot buttons that matter most when trying to determine eligibility. If you improve one of these areas, you can change or unlock new opportunities for down payment assistance, etc. If your income goes up, income-based programs you may not qualify for, but understand that if your income goes up, you're going to qualify to buy more house. If your credit improves, that's going to give you a better financing options. And if your debt goes down, then that's going to obviously improve your ability to qualify for more home as well. So with income, lenders are looking for a few things. They're looking again for consistent income history. Last 2 years of your employment history is critical, ideally in the same field or a field that is close to. Going from job to job and increasing in income, going from job to job, essentially growing is always a good thing. So don't think that you have to stay on the same job. Oftentimes, I've heard it said that someone got from somebody um, saying that you have to be on the same job for 2 years. No, you do not have to be on the exact same job for 2 years. You can be on different jobs. The history, having 2 years of employment. What is your employment history over the last 2 years been? That is what that is. If you're coming out of college and going straight into the workforce, you're not going to have 2 years of history in a job. However, programs do accept and do look at, okay, you just came out of college. Yeah, you got 6 months or a year You have a letter saying that this is what your income is going to be, and lenders will accept that oftentimes and qualify you. You don't have to wait to the 2 year mark. Now, if you're self-employed, you go from being employed to self-employed. Now, at that point in time, you're going to have at least 2 years of employment as a self-employed person in order to qualify. Different animal, but I want to make that clarity so no one misses that, because sometimes people, oh, well, you said no, no, no. This is how this works. Income needs to be able to be verified through W-2s, tax returns, pay stubs, or bank statements. Lenders need documentation. They don't need estimates. They need actual documentation because this is required in the underwriting process. Household income may count. So some programs that you may be thinking you may be eligible for, some of the things that we've talked about, you all may remember I gave a scenario, actual scenario of someone who bought a home for 200,000, new construction, 3 bedroom, 2 bath, site built home in North Charleston. Yes, yeah, I'm gonna let that sink in. Got an additional $25,000 in down payment assistance. Yeah, on top of the subsidy that was involved in that to make that home 200,000 versus 300 and change, which is the cost to construct and sell. So in a situation such as that, household income is what is used to qualify. So other people in the home, whether it's spouse, children, anybody else who is working, their income is considered in that calculation as well. And that could change your eligibility as well. So here's a reality check in regards to income. Many people assume that they don't make enough money to qualify to buy a house. Oftentimes I hear that, right? Let's be real. Let's be very real. You may not make enough money to qualify for the home that you want. That doesn't mean that you don't make enough money to qualify for a home at all. So let's just be very fair and direct right there. This is probably the number one reason why buyers usually don't even apply for a mortgage or don't apply or even explore home ownership, because they are thinking, oh, I can't qualify. I don't make enough money, because somebody else has said this, not because they've talked to a professional. Oftentimes people, I've seen it often, that people put on social media, if you don't make this much money, don't be coming out here trying to buy a house. No, there's options. There are options. So let's make sure that we're clear in that. Many programs that are out here that are designed for down payment assistance and the like are designed for moderate income earners, not those with just low incomes in their household. Now, those income limits, and it's interesting, I'm even covering this now, but those income limits are often for buyers in the 80 to 120% mark of area median income, right? So many of you don't know AMI. AMI, area median income, it is a calculation. HUD every year looks at geographic areas. They call them MSAs, metro service areas. So essentially the metro of Charleston and North Charleston, everything within that metro area, there's an income that is calculated, and then there's a chart that's put out that says 80% is this number and below, 100% is this number and below, 120% is this amount and below. The income for an 80% single person household, no children, just one person in the household, currently rests about $63,000. Many times people look at that and say, I have to make that much money in order to buy a home or qualify for a home under that program. That is not correct. You cannot make more than that. That is correct. So if I am selling a home or have a buyer looking for a home and they have an income of $60,000, they in their single person household, they will qualify for any down payment assistance program where the income cannot exceed 80% of area median income. That particular mark allowed me recently and a number of times over the years to stack programs where I literally have gotten people, one of the more recent cases, about 180,000 close to $190,000 off of the price of a home by stacking the programs because their income was below that amount. The next bracket is 100%. Now, it doesn't mean you have to make between 80 and 100. You just have to be below 100. So every program has its own. You can't make more than 80%. You can't make more than 100. You can't make more than 120. So if you're a buyer who doesn't qualify for 80% AMI programs, maybe you qualify for 100% programs because you're above 80 and below 100. Maybe you qualify for or don't qualify for the 100% programs, but you qualify for the 120 because your income is above 100 but below the 120. However, an 80% buyer qualifies for the 120 programs as well as the 100% program. So if they're looking at a particular property, if they qualify otherwise and the home price is affordable and attainable for them, just because they make less than the income cap at 100% or 120%, they still qualify. So many times people are reading that language wrong, or they're interpreting it incorrectly to say that you got to make between this amount and this amount to qualify. And that is not the case. The reference in the language is the programs are designed to serve people at or below, depending upon in each particular property in a given development. If it's a workforce housing development, each unit within that development sometimes has a different requirement. Maybe this unit you got to be under 80, this one you got to be under 100, this one you have to be under 120. But it's all under numbers. So I want to be very clear in that. These programs vary by location. They also vary by loan type. You can pile on assistance if you're eligible and if you qualify. So you may qualify for one program, but not qualify for another. So you want to make sure that you're talking with people and working with people that understand and can put it all together. And more importantly, have the right professional, the right real estate agent, the right realtor guide you through the process. The only way for you really to know is to have the conversation with somebody who does know, meaning a professional. Trying to do it, figure it out on your own. We're in a DIY society. Everybody wants to do it themselves. I can appreciate that. However, you may fit this, you may not fit this. Then doing this or doing that may or may not qualify you. You want to make sure you're talking with somebody who really understands and knows. Next is credit. Here's what actually matters in regards to that. Yes, your credit score is very important. Very important. This is probably a great opportunity to segue and tell you that just because you saw it on Credit Karma or whatever other app you may have, that may or may not be the same score that the lender is getting when they pull your credit. Credit scores are weighed differently for mortgages than they are for consumer-based products. If you're buying a car, the credit bureau that they use and the weighting of the score is different than what happens when you're running an application for a mortgage. If you are running application for a mortgage, the scores are weighed differently. All bureaus, all three bureaus, Equifax, TransUnion, and Experian, are pulled, and whatever number in whatever succession chronologically is in the middle is the score that they're going to use. So they're not using a particular credit bureau. Consumers ask this all the time. What credit bureau are they going to use? No, they're going to check all of them. So if you have a 615, a 640, and a 650, they're going to use the 640 as your credit score. And it doesn't matter if it's TransUnion, Equifax, or Experian, whatever number in the middle for the weighting as well as the balance in the score, that is most indicative of your credit profile. Now, here's a quick tip and trick. Take this out. This is a perfect place for me to say, clip it. The tip and the trick is this. The tip is if you have an account that goes against or is in very, very, very good standing, and it shows up, usually this is a car loan or some other loan that they only report it to one credit bureau, you can request them to report it to the others. So maybe you have a car loan that shows up on your TransUnion, but doesn't show up on your Experian and Equifax. You can have them report it. And that could help you to shore up or otherwise improve your scores on those other credit profiles, on those other credit models. So understand your score is important. That's just a starting point, right? The history matters as well. How long have you had the credit? What's your payment patterns? Are you missing payments? Those kind of things. They don't necessarily see late payments unless they go 30 days late. So just because you paid your credit card bill a day late or 5 days late does not mean that there's a blemish on your credit score. Would never show up on your credit bureau unless you're 30 days or more late. Your direction matters more than being perfect. So a score that's going or trending upwards is looked at more favorably than one that is otherwise stagnant or declining. So this is not, every program is different. So we're going to touch on some high level stuff here briefly. So I want to be very clear and say to you that this is not it. Okay. Sometimes we think, oh, I can, and that's it. No, no, no. So FHA as a program in its guidelines, not what lenders do, but as a guideline established by FHA, Federal Housing Administration, to be eligible for a loan with their lowest down payment percentage, which is 3.5%, you have to have a 580 score or above, right? There are options under FHA for scores between 550 and 580, as well as between 500 and 550. They just require a little bit more money down. That is what the program guidelines say. Some lenders just merely operate off the program guidelines. Some have what we refer to as overlays, where maybe I won't give a loan to a buyer at 3.5% under at 580. Maybe I won't do that till they're at 620, maybe 640. That is up to each individual lender. And the reason why it is because the lender is responsible for defaults on that loan. So if they give a loan to a borrower with a lower credit score and that loan defaults, then they're responsible for that loan. So some lenders, some banks would not underwrite an FHA loan with a score below a certain area, a certain model. Getting to a 620 or above gets you to more options in your financing. It gets you to some different programs. It gets you to some different down payment assistance programs as well. 680 and above gets you even better terms, access to better or more competitive interest rates, possibly lower mortgage insurance requirements as well. And then for the best rates and all those things, having a 740 or above is best. However, that doesn't mean that you will automatically qualify, and it also doesn't mean that you're automatically disqualified. So please don't say that you got to have a 620 to qualify to buy a mortgage or buy a home. That's not true. Because there are options. Don't say that you have to have at least a 680 or at least a 740 or any other number that may be made up or otherwise being transported around. Short version is everybody's situation as well as their personal and financial profile differs. It's a case by case. Let's see how we can help you to achieve home ownership. So here's some additional quick tips on how to improve your credit. Pay down your balances. Reducing your credit card utilization to below 30%. To be frank, if you can go lower than that would be great, but reducing your credit card balances will give you an increase in your credit score. Avoid new collections. Negotiate if you need to avoid having a collection. Keep your accounts current and avoid opening additional unnecessary credit. Okay. Each application is a hard inquiry that works to pull your credit score down. So if you're going to look to apply for a mortgage, wait before you apply for new credit. So that way those inquiries don't show up in your credit profile and don't act against you in the application process. So the silent factor is debt. All right. So lenders measure your total debt, your total monthly outgoing payments that are revolving. Those payments, they compare that to your gross monthly income, again, gross monthly income. And they also look at the type of debt that you carry, credit card bills versus personal loans and things of that nature. What factors into this are things such as your car loans, your credit card payments when you're not paying the full balance, student loans if you have those, even the ones that are deferred may have to be applied or otherwise calculated into your debt ratio. And again, any revolving installment loan or other revolving debt, those are factored in as well. So it's not about how much money you owe, it's about what the minimum monthly payments are. That's what's calculated in. So let's break down DTI, debt to income, this ratio. This is the number that lenders work from. It is kind of that hinge point in the entire process. If the credit's good, the income is good. We're going to look at the debt, we're going to calculate it. And that point in time, we start to figure these things out. So the sum of all your debts, your monthly debts, add that up. That's what you want to start with. Next, you want to divide that by your gross monthly income. So if you're doing this on a calculator, pull your minimum payments. Maybe not what you pay. Maybe you have a minimum $25 a month payment on a credit card. Maybe you pay $50 a month. You use the 25, not the 50, because that's the minimum amount. That's what's being reported to the credit bureau. That's the number that you use. Your DTI is the calculation of that sum of those monthly revolving debts, car payment, loans, etc. You divide that by your gross monthly income. So this is your before tax number, your before tax number. That DTI, that ratio, that percentage is considered to be your DTI. The lower that percentage is, the better you are. So you have a 30 to 90-day window. And as people who talk about wanting to own a home, most times this isn't spoken about. That window of time that I'm speaking of is a time for you to get things in order. You don't have to work. I mean, sometimes, you may have other things to do, but the last 30 or 90 days leading up to qualifying is probably most critical. This is the time when you should be looking in your first 30 days to look at your credit report, have an understanding of your DTI, start to pull your income information and documentation together. Income information and documentation is pay stubs, tax returns, bank statements. This will help to identify like where the pinch points, issues, or what have you may be. Your next 30 days, if you need the next 30 days, that's the time to work on getting your balances on your credit cards or revolving loans or whatever paid down, to make sure that all your accounts are current, obviously. And then you begin having a conversation with the mortgage lender. That last period of time is when you start to recheck your numbers, and that's when you are able to be confirmed or have a better idea you qualify for this program. And then with that, you can move more confidently through the pre-approval process. Remember, you do not need forever to quote unquote qualify to buy a home. That's one of the reasons why people are sometimes more hesitant. They think it just takes so long. But the key is getting the strategy in place early, starting to focus and dial in early. And doing so allows you to be ahead of the game. So here's some common mistakes that people make in regards to qualification. One, they wait, they don't have a plan. That's a big one. We talked about this in a previous session. Waiting but not making improvement does you no good. Waiting for lower interest rates, waiting for lower prices, all those things, for many that has worked against them more so than helped them. Your position has to change. Waiting doesn't necessarily change your position without being intentional in what you're doing. Number two, not checking your credit, making sure that everything that's on your credit profile is accurate. All the credit bureaus will give you a free copy of your credit report, not the score. The score is not free. You can go to annualcreditreport.com, request a copy of your credit report. The score, they'll make you pay for, but the score is irrelevant because the score they'll give you is not the same score that the lender will pull when they review your application for a mortgage. Please just look at the credit report to make sure there's nothing on the report that is inaccurate. Number three, taking on new debt. Going to buy a car before you go buy a house is probably one of the biggest things that hinders or slows people in their process. If you're going to buy a car, buy the house first, then buy the car. I can tell you a story and I'll make it brief. I remember meeting with some folks some years ago. They were excited about wanting to buy a home, so disappeared, came back months later. They were under contract to buy a home. And unfortunately, were not able to close on the home because their car had quit or they had a mechanical failure with the car. And instead of fixing the car, they went and bought a new car. And buying a new car increased their debt ratio, and they no longer qualify for the home that was being built specifically for them. They were literally within a couple of weeks of being able to move into their new home, and now all of a sudden they couldn't buy. Taking on new debt is one of the biggest things that I see that happens that hinders people. Number four kind of echoes in what I just talked about, which is not speaking to a professional early. They didn't engage me or any other real estate professional in their process when they were actually purchasing. So they didn't have anyone to go to. They didn't have any guidance. They didn't have any direction while they were going through to remind them, hey, don't do this. Let's figure out another way. If they had, then maybe they'd be homeowners, or maybe they would have been homeowners then. So make sure that you're talking to a professional early so you can get the guidance and the assistance that you need. So here's what you should do instead. Again, qualification isn't something that just happens and it doesn't happen to you. It's something that you build toward by being intentional. So we want to make a shift mentally from acting passively in regards to home ownership to acting with intention. Number one, understand your numbers, know your credit, understand your DTI, and make sure your income is documented. That's the baseline. Number two, you want to build a strategy based on that. And that's, again, when you engage with a professional, these are the three things that will help you do. Will help you identify things that you can make improvements on. Last thing is make those improvements. Be specific, again, target, dial in, track your progress, and adjust so you can stay on course to achieve home ownership. This lines you up to getting pre-approved. I always jokingly say this. I don't know many people that go grocery shopping without knowing how much money they have. So you don't want to necessarily go home shopping without knowing how much money you have or what your budget is to purchase a home. This is one of the most powerful moves that you can make as a buyer. It literally transports you from being a prospect into a fully qualified, a credible buyer. So this helps you to confirm what you qualify for. There's no guessing, etc. People are looking at $500 homes and want $1,000 or expect they're going to have $1,000 a month mortgage payment. That's not how that goes unless you got a lot of money to put down in order to make that possible. Getting pre-approved will help you to understand what the payments will be, what the process is, and what you qualify for, again, if you do qualify for affordable housing programs. The next piece, it helps you to identify the programs that you might be qualified for. Again, those assistance programs, specialized loan options that we've talked about otherwise. And it also gets you in a position to be able to move quickly. If a home hits the market that you're interested in and you're eligible for assistance and qualify to buy it, that's something that you can jump on immediately without having to be, or otherwise being disappointed or otherwise delayed in your particular process. Oftentimes, we see, people, say they're delayed but not denied, and I get that. However, if you're prepared, then you're less likely to be delayed. So let's make sure that we work on that. Matching with the right program. Again, every assistance program is not designed to work for every buyer. Everybody won't qualify for the same program. And trying to use the wrong program may do you more harm than good. Oftentimes, people come in and say, well, I want this kind of loan or this or that, and they don't know about the other options. Understanding that you as a consumer are different. You want different homes. You can qualify and eligible for different payments. You want to live in different areas. So there's all types of programs. You got FHA loans, which is a federal program, loan insurance program that was designed to help people with affordability way back yonder when it was first established. By accepting buyers with lower credit scores and down payment thresholds, that was one of the first government options and programs to do so. Next up is USDA loans. These are options for those who are looking in rural areas. And oftentimes you're looking at no down payment for these particular programs. Then you also have local as long as state down payment assistance programs that offset down payment requirements and or closing costs that are needed at the table. There's first time home buyer grants, some that don't need to be repaid. There are also conventional loan programs that go up to 97% loan to value of financing, so it requires a 3% down payment. And there's other programs as well, such as VA, that's designed strategically just for veterans. So figuring out what you're eligible for kind of becomes a part of that process as you are discussing with the professionals. This is what my situation is. This is what I'm looking for. And in turn, matching those things up to get you to what your eligibility is. So let's talk about what this means for you, right? This is where the takeaway is. This is your takeaway. So you don't need to guess, you need a plan. You need to engage with a professional, someone who understands these programs to walk through what homeownership would look like, could be otherwise for you. Understanding that the path to homeownership is rarely as complicated as it feels and as complicated as we make it. What many buyers need isn't a better financial situation. They just need better information. They need guidance and they need to understand what that first step is clearly. So, again, you need a plan, which is your roadmap. You need guidance, so you need someone who understands the landscape on these programs. You also need to act. The most important step isn't the perfect one, it's taking the first one. If you have children, all of us have been a child at one point in time. We've attempted to take a first step. It was probably clumsy, may have failed, but if we did so, then here we are now later able to do more. You got to act, you got to do something. All right. So making the first move is critical in order to reach or attain the goal that we're after. So I want you to understand that the opportunity that you seek may be a whole lot closer than what you think. The gap that you may perceive that exists between where you are and where you need to be is oftentimes smaller than what it may appear. What it looks like could be a mountain when really it's just a hill. All right. So understand that you can make the gap smaller, taking incremental steps, but taking the first step, but taking incremental steps will make it more of something that you can accomplish versus something that you never will. There's an old adage about how do you eat an elephant? Well, you eat it one bite at a time. The key difference again is what you do, the action. Because two buyers with a similar profile, one becomes a homeowner, one doesn't. One did something different than the other. So you want to be that person that does something different. So let's talk about next steps as we seek to build your path or create your roadmap. You have framework from this. Go back to your other videos and get more information. But understand that the next move is yours. It's your responsibility to do it for you, to do it for your family, or whoever it is that you are, or whoever is, quote unquote, the person or persons that you're going to do this for. Number one, you want to make sure that you review your situation, your income, have an understanding of what's going on with your credit, understand what your monthly obligations are. This is your opportunity also to build your budget. What can you afford? If you're paying rent, then that's usually, if you're paying rent and you're okay, meaning financially you can afford the rent, then that's usually kind of a guideline as to what you may be able to afford. Sometimes people can increase. Maybe you're paying $17, $18 a month in rent. You're comfortable paying $2,200 a month in a mortgage, whatever that looks like. That's what you decide during this review process. Identify, hey, I want to be in this kind of area. I want this type of home. Number three is the plan. Start building, okay, I need to be doing this, I need to be doing this. But engage with a professional early. This is a time really to call, myself, realtor, whoever, and start having the conversation, to start understanding, hey, this is what I need to be doing. This is when you reach out for that consultation and start working through everything that you need to do. Your path to home ownership, guys, begins with the conversation. So here's how you maximize, or next up in our series is going to be maximizing your home ownership opportunities. So we're going to go a little bit deeper. We're going to talk about choosing the right path, structuring a deal, and making the most out of your options. This is making a mountain into a molehill. So glad to have been with you today. I trust that this session has been informational, educational to you. My name is Corwin J. Millett. I'm the broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina. If you're ready to take the next step, this is my information. You can reach me here at the office, 843-619-3005. You can feel free to set an appointment with me once you engage with our staff. They'll be glad to do so. You can email me, corwin@corwinmillett.com. You can visit our website at exitlowcountry.com, or better yet, you can take a picture of this QR code and set an appointment with me on my calendar. I trust that you've gotten some good use and good information out of all this today. I look forward to assisting you here in the future. Take care. Have a great day.